Hey guys, what's up? I'm Erin and welcome back to the channel. Planning for retirement isn't just about hitting a number. It's also about protecting that number from the forces that can quietly wipe out your future. These are the real risks that every retiree faces, and in this video, I want to show you what they are, why they matter, and exactly how to protect yourself. The first one is the withdrawal rate risk. Here's why this matters. In retirement, generally, you're no longer building wealth. Instead, you're spending it. So if you withdraw too much too soon, you could run the very real risk of running out of money, even if your investments perform well. The 4% rule is a very common guide, and it's based on the absolute worst case scenario, referencing historical data. It also assumes a 30-year retirement, low investment fees, does not factor in taxes, and assumes a steady withdrawal rate. More recent research has led to that figure being updated to about 4.7%, which should be good news for many retirees. But remember that this is only under the right conditions, meaning you have the proper portfolio mix. And I do have a full video on this if that is something you're interested, and I can link it above and down below. On the other hand, if you're planning for a longer retirement, you might want to go with a more conservative withdrawal rate. Or if you're planning for a shorter retirement or you have more guaranteed income streams, maybe you're more comfortable with a more aggressive rate. It really comes down to your situation. No matter what your situation, here's how you can protect yourself. Number one, use dynamic withdrawal strategies. Adjust how much you take out of your portfolio based on market performance. When the market is robust and strong, you can take out more. When the markets are down, you can take out less. Track your spending, the essentials and the discretionary. Know what's fixed. Maybe that's housing and healthcare. Know what's flexible. Maybe that's travel and hobbies. And in the tough years, maybe you're willing to cut back on the non-essentials. Perhaps you use a guardrails approach. Strategies like the Guyton-Klinger rules allow you to raise and lower your withdrawal based on your portfolio performance. This adds structure to your withdrawals without having a rigidness. And importantly, build a cash bucket. I cannot overstate the importance of a cash bucket, especially as you go into retirement. You want to keep anywhere from, say, 2 to 5 years worth of expenses. Keep part of it highly liquid and ready to access. Other parts in short-term investments that are stable, so you still know it's there. And this allows you to have a safety net. You don't have to sell portions of your portfolio in the event of a market downturn. Instead, you can leave your money invested and allow it the time it needs to recover. Morningstar found that retirees with a 2-year cash reserve had a 10 to 20% higher chance of their portfolio lasting 30 years, especially in volatile markets. Next up is sequence of returns risk. Here's why this matters. Let's say you save diligently, you invest regularly, and by the time you're ready to retire, you have that often cited $1 million portfolio. Feels pretty good, right? But then right as you start to draw from your portfolio, the market crashes. And this can quietly make it so that your portfolio runs the very real risk of running out of money. This is sequence of returns risk. And even with solid long-term returns, your portfolio could still dry up much faster. Let's break it down with real numbers. Meet two retirees, retiree A and retiree B. Both start with $1 million invested. Both withdraw $40,000 a year, and both experience the same average market return over 25 years. But one key difference, the sequence of returns is reversed. Scenario 1, bad returns early. Year 1, market drops 15%. Year 2, another 10% drop. Year 3, small recovery, but at this point, the portfolio is just over $660,000, and they're still withdrawing $40,000 a year. Even as the market improves later, the damage is done. They had to sell during the market downturn, they locked in their loss, and they can't fully capture the rebound. Scenario 2, good returns early. Year 1, the market gains 8%. Year 2, it's up again. Year 3, another small increase. We have a balance in our portfolio that is still over $1 million. And during this same period, we're making the same $40,000 withdrawals. Same average return in the long run. But retiree B stepped away from the workforce into a robust market. This allowed them to build in a buffer for when those inevitable market downturns happen later. Let's look at the portfolio balances 25 years into retirement. With scenario A, bad returns early, our portfolio is about $720,000. In scenario B, with good returns early, it's about $1.5 million. Same returns, same withdrawals, completely different outcomes. So timing absolutely matters. Early losses plus withdrawals can be a dangerous combination. That is why this is one of the most dangerous and misunderstood risks in retirement, and that is why your withdrawal strategy and a cash buffer matter so much. Here's how you can protect yourself. Number one, use a bucket strategy. Keep 2 to 5 years worth of cash reserves liquid and at the ready. And remember that same emergency fund we talked about in the previous step? It protects you here too. If you can, avoid selling growth assets during a downturn. Use your safety money first, let your investments recover, and then once they do, you can replenish your safety net. And stay flexible. If your budget runs tight, when the market is down, cut discretionary spending. Then once the market recovers, you can ease up again on your budget. Sequence of returns isn't about average returns over time. It's about when those returns hit. So maybe if you plan for the worst case scenario, you'll be ready for whatever happens next. Inflation risk. Let's say you retired in 2000 with a $45,000 a year lifestyle. By 2025, you'd need about $84,000 to afford that exact same lifestyle. That's nearly double just to maintain your standard of living. Cumulative inflation over that period, 87%. But there is nuance here that we should talk about. Not all expenses inflate equally. If you retire with a paid-off home or a fixed-rate mortgage, you've sort of locked in your housing expenses. And studies show that for most retirees, housing eats up about 30% of their budget. So if you lock this in, it can really lower the impact that inflation has on your budget over time. The best ways to combat inflation in retirement? Number one, make sure to utilize a high-yield savings account. Your emergency fund is incredibly important, but don't let cash just sit idle. Make sure you're putting it somewhere where it's going to capture a decent rate of return so you can maintain your purchasing power. Consider more aggressive investing even as you age. This may sound counterintuitive, but many financial planners now recommend that you increase your stock exposure as you age, especially in longer retirements. This will help you preserve your purchasing power over time. Bonds and cash alone will not keep pace. Consider delaying Social Security. For each year you delay claiming Social Security past full retirement age, your benefit will increase by 8%. That can have a meaningful impact on your budget. And remember that Social Security is cost of living adjusted, but often it's said that these cost of living adjustments don't keep pace with the real inflation that retirees experience, especially in areas like healthcare, which tend to increase at a rate that is higher than inflation. Fix your housing costs if you can. I know we just mentioned this one, but if you can find a way to lock in your housing costs or have a completely paid off home, this can give you a lot of flexibility within your budget. If you're renting, assume that your rent is going to increase on an annual basis and that your housing costs will increase progressively more over time. Perhaps you even consider relocating to a lower cost of living area. Perhaps you consider relocating to an area with lower taxes or cheaper healthcare. And if you're having a retirement that's going to last 30 or 40 years, this can absolutely make a big difference on your budget. But it is worth considering there is a cost to relocating. You have to learn a new community, establish new friendships. Those things are important as well. The bottom line is that inflation is real, and yes, it is powerful, but if you have a strong portfolio and a strong handle on your expenses, you likely don't need double the income just to keep up throughout the course of your retirement. And remember, if you're following a safe withdrawal strategy like the 4% rule, these withdrawal strategies already have inflation factored in. Your future cost of living is baked into the plan. So if you've been really intentional about how you save, invest, and spend, you're probably more protected from inflation than you realize. Next up, longevity risk. Here's why it matters. What if you retire at 65 and plan a 20-year retirement, but then say you live to 95 or 100? You need your money to last as long as you do. It does you no good to run out of money before you run out of time. And your expenses are still going to be there. You're going to have healthcare, inflation, market volatility, and usually these things tend to compound over time. And running out of money isn't just theoretical. It is a very real risk that we have to address as people are living longer than ever. The average retirement age in the US is 62 to 65. Life expectancy at the age of 65, for men, it's about 84. For women, it's about 87. But those are just averages, and averages don't plan for your life. Have you heard of the 50% rule? If you're a 65-year-old couple, there's about a 50% chance that one of you will live past the age of 90. That means planning for a 30-year retirement isn't callous, it's realistic. Most modern retirement plans plan for a retirement that could easily last until the age of 95 or 100. And that is because longevity risk is very real and you want to make sure your money lasts just as long as you do. How you can best protect yourself here? 1. Plan conservatively. Build a retirement plan that assumes you live until at least your late 90s. And if you don't, you just end up leaving behind a surplus. That's not too bad. Make sure to secure your baseline income. Having really strong guaranteed income streams can make all the difference in the world. It could be Social Security, it could be a pension, it could be other income streams. Something that lets you know that this income is coming every single month. It makes you less reliant on market performance and it can give you great peace of mind. Keep growth in your portfolio. Even in retirement, you need equity exposure. You need your money growing over time so you can maintain your purchasing power for 20, 30, or 35 years. Longevity risk is often underestimated, but it can absolutely be financially devastating. The solution is simple. Plan for a long life, and I hope you have a very long and very healthy life. Because the real risk isn't dying too soon, it's living longer than your money lasts. Next up, spending shocks. As much as we would like it to be, retirement isn't a smooth and peaceful ride. Instead, life still continues to throw you curveballs. That could be a leaking roof, a medical scare, an adult child needing financial help. These events aren't rare. In fact, 70% of retirees face at least one major unplanned expense, often early in retirement, when your portfolio is most fragile. Here's why it's risky. If you experience a surprise expense during your working career, maybe you can make short-term cuts, or maybe you can find a way to boost your income. However, during retirement, many people are living on a fixed income. But if you're forced to withdraw from your portfolio to cover this expense during a market downturn, this could inevitably compound your losses and shorten the lifespan of your portfolio. Here's how to protect yourself. Keep an emergency fund, even in retirement, or especially in retirement. Again, this is that same emergency fund we keep referencing because it protects you from a lot of different risks in retirement, and that's why it's so important. Plan for long-term care. The data is mixed on how many retirees will truly need long-term care, but it is something worth building into your plan. Medical expenses are very real, so you want to make sure no matter what life throws at you, you have a way to cover it. So fund a healthcare bucket. Set clear boundaries with family. Of course, we all want to help our kids, but overgiving, especially early on, can jeopardize your own personal financial security. So be generous, but make sure you stay grounded in your plan. And finally, healthcare risk. The cost of healthcare typically increases at a rate faster than inflation, and seniors tend to spend more in this area than young adults. A single diagnosis, a fall, or an unexpected hospital stay can cost tens or even hundreds of thousands of dollars and derail the retirement lifestyle you've worked so hard to build. Here's what most people overlook. Your retirement health begins today. No matter what age you are, chronic conditions like high blood pressure, back pain, joint pain, these don't just arrive overnight. They tend to start early in life, maybe your late 30s or your 40s, and then they show up in your 50s and 60s. Consider that nearly 60% of adults aged 50 to 64 already have at least one chronic condition. By age 65, that number jumps to 80%. The good news is that many of these conditions are entirely preventable or reversible even later in life. So this isn't just about aging, it's about ensuring that you get to live the lifestyle you truly want to. How you can protect yourself? Start with prevention. Now, take care of your health throughout the course of your entire life, even during your working years. Move, sleep, eat, de-stress. Health is wealth at every stage. Know what Medicare covers and what it doesn't. Medicare doesn't cover everything. There are absolutely gaps, so know what you're looking at. Add supplemental coverage. These plans are all different, so make sure you pick the one that is right for you and still build a cash buffer on the side because it's likely you're still going to have personal expenses as well. And really just budget for rising healthcare costs. Healthcare spending tends to increase with age, so make sure you build that into your budget. One of the best things you can do for your retirement plan has absolutely nothing to do with money, and that is taking care of your body so you can go into retirement not having to recover from neglecting it for years. Retirement should really be a time for you to live fully, not for you to be forced to slow down. You don't need a complicated retirement plan, just a resilient one. A cash bucket gives you flexibility during downturns. Growth investments help you outpace inflation. Guaranteed income covers your essentials, and fixed housing costs reduce pressure. Most important, take care of your health now. It's one of the biggest long-term investments you can make. These 6 risks can threaten anyone's budget, but they're not unbeatable. What you need is a strong plan, and that way you can go into retirement with peace of mind. Do you have 1 or 2 that are the most concerning for you? Share your thoughts in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Understate the importance. Nope, overstate. It's regularly. You're ready to sign off? No. Hey guys. Am I going back to the beginning? I don't know what. I didn't sleep last night. Like, jeez, oh Pete's. Discretionary expense. I don't even know why I'm doing it. This has the biggest concern